In this business, I really think it comes down to three things: finding deals, getting access to capital and funding your projects, and managing those assets effectively. So I think about technologies that can help there, and finding deals as all types of AI technology that you can use to underwrite and analyze projects. When it comes to raising equity capital, as investment management platforms, so that you're not just using a spreadsheet like so many funds out there.
Welcome to the How to Scale Commercial Real Estate Show. Whether you are an active or passive investor, we'll teach you how to scale your real estate investing business into something big.
Zain Jaffer is a lifelong entrepreneur who started his first venture when he was just a teenager. He co-founded mobile advertising startup Vungle, which was acquired by Blackstone in 2019 for $780 million. And shortly afterward, he started Zain Ventures, his family office that boasts a diverse portfolio of real estate investments and tech startups. He also can be heard sharing his insights on the Prop Tech VC podcast. Zain, welcome to the show.
Thank you for having me.
Zain, the same three questions I ask everyone who comes on the show. Can you quickly tell us, where did you start? Where are you now? And how did you get there?
Where did I start? I started in the UK, as you can probably tell by my accent. And I was in the tech industry. So I was building websites and trying to hustle to make some money. And eventually, after a series of startups, many failures, I hit it pretty big. And for years, not taking a salary as a founder, I saw all these people in real estate getting cash flow, leveraging up, taking advantage of tax advantage situations, and basically assets would appreciate. And I was like, I want to get a piece of that. And so when I had my exit, I decided to get involved in real estate because it was so different to being a founder.
That is incredible. That's, for the people who are in the founder tech startup space, that seems so sexy. It seems so like, the glitz and the glam, and wow, while you're in tech startups and you're looking at this side of the equation going, wait, that's where I want to be, because that just seems too predictable. Is that right?
I'm sure I can say our now, not your, because I'm now in the real estate industry. There are horror stories of tech founders who make a bunch of money, invest it into real estate, and lose so much.
Really?
There's a lot less stories of real estate people starting companies, right? But there's a lot of stories about people getting into real estate, and I definitely struggled along the way. But now that I found my groove, I love it. It's an amazing asset class.
Talk to us about that groove. What was that like? Certainly hearing stories of tech founders made a pile of money and then lost it all. That's not exactly the warm welcome into the real estate world. It makes me go, I want to get in. So talk to us about how you got in, how you found your groove.
Well, on that warm welcome, I think everyone who goes into real estate needs to expect that the first few deals you're going to lose money on. Unfortunately, if you come in with a lot of money, you're going to lose a lot of money. That's why it's safer to sometimes come in as a syndicator or as an agent and, climb your way up the value chain. For me, I came with a lot of biases. Coming from tech, things move very quickly. Everything's urgent and needs to be dealt with now and today. And I took, as a founder, I'm very optimistic. And I think coming into real estate, it was a hard lesson to learn. Things definitely don't move very quickly. There is no urgency. Things can always wait. Unless it's a tenant, of course. Sure. then you're taking that phone call at midnight when the plumbing isn't working.
Right.
And you can't be so optimistic. Actually, there is a lot of I tell you, I've encountered a lot of dishonest people being in the real estate sector. I was quite dismayed at how much dishonesty there is and how easy it is to get taken advantage of, especially when someone sees you. When you call up, for example, I'm calling from California, the number code comes up as California, and the inside joke in the industry is, when it's the Silicon Valley 650415 number code, prices go up 20%, when they ask how much it is. And I definitely felt that, and I had to try to keep a low profile coming in. But eventually, I just felt like I was getting taken advantage of by a lot of people, especially the type of investing I did. I'd go into tertiary, secondary markets. Not immediately, but eventually. And in those situations, I really felt that people could tell I'm not from here. I fit that stereotype of someone who's in California trying to expand into these secondary markets everywhere. And vendors are charging you a fortune, and, people are just milking you, I feel.
Yeah, that's really interesting. I always say that It's interesting to hear a different perspective on this because, for me, I find this to be one of the most collaborative industries. Just in the sense that, so many of us can work together on the same project towards a common goal, from capital raisers to, deal finders to sponsors to property managers. I feel like it's very collaborative on that front. So it's interesting from the outside in to hear a different perspective going, wait, there's also some sharks out here to look out for. Were there other things that made you feel like it was maybe a dishonest or not, that people could be dishonest in this industry? And then how did you overcome those?
Well, Sam, just before we dive into that, and I appreciate it looks collaborative from where you are. I'd say it feels the same when you're in the tech world too. It's collaborative, but for a new person to break into that circle, it's hard. And I felt real estate's very cliquey. It's a lot of relationships. It's people you've worked with for a long time. And people always do business together. And when they do business together, that's when they'll cut each other a good deal and there's a lot more honesty. If you're seen as someone from out of town or someone who doesn't have staying power, then you're more likely to get taken advantage of. I find this in every industry.
Sure.
The dynamics are such that when you're a vendor in the industry, you're always doing business with other vendors, you get sweetheart deals. But, even in the tech industry, if you're selling your company once or raising finance once, you're probably not going to get a good deal. But if you're buying companies all the time or you're an agent, then, you're going to get much sweeter deals. Now, I would say that I don't think it's necessarily that people were dishonest as much as I was too optimistic. When you look at pro formers, it's your job to have that. It's your job to be skeptical and to suddenly realize, wait, that pro forma is if everything works out perfectly.
Correct. I don't know anybody who believes a broker's pro forma.
Oh, I know. And out of town, when interest rates are so low and you've got access to capital, you're like, oh, wow, I can generate a good return on this. And then also you get focused on metrics like cap rates, or one metric too much, like cash on cash returns, and you lose sight of the bigger picture. I think those were some of the amateur mistakes I made. And, it's about the business partners you work with too. You've got to make sure that things are aligned. And I, for example, dealt with some construction people who weren't very honest, and things overran significantly.
Right.
And I think those were very important lessons and were battle scars to be proud of, because now, my real estate portfolio is growing significantly. I even partnered up, which was, I think, a key way to mitigate risk, find other partners. Now I'm part of a platform. I'm a general partner at a private equity real estate fund called Bluefield Capital now. So I don't just do family office investments. Now I do more investments through the private equity fund. And that's when I'm like, wow, I was an amateur coming in by myself. Now that I have business partners and I have access to, all kinds of things I didn't have access to, I can see why this is a game where it favors people who have relationships.
Yes. And that's 100%. And I don't know that that's untrue across any industry. Life favors relationships, and it's certainly there. Talk to us about that transition. I guess you're trying to get into it. You say, man, okay, I'm not loving what I'm seeing, but yet you've moved forward, and then you started or joined the team with Bluefield Ventures. I'm not sure if you started that or.
So then I ended up joining Bluefield Capital, which is a private equity real estate fund, has multifamily, hospitality, industrial warehouses, senior care facilities, some student rentals, and then we're looking at some fun assets too, like trying to roll up single family rentals, ground up construction of townhomes, also ghost kitchens and emerging assets like that. I think the biggest learning I had was that when I came in, I diversified my family office pretty effectively. I was an LP in a bunch of assets. And a bunch of funds. I invested in RXR, Bridge, Blackstone, Bluefield Capital as well. And then I decided, let me do my own stuff. And I did a variety of things. I bought single family rentals. I did hard money lending. I started buying multifamily apartments and Section 8 housing and you name it, right? I was doing it. And year end came and I'm working really hard now trying to make this real estate sweat for me. And then I get the K1s from my funds and I'm like, they're outperforming me. How is this possible? I didn't want to I put a fair amount of my net worth into funds, right, but I wanted to leave quite a bit aside for me to play with to learn real estate.
Sure.
And I just couldn't fathom. I'm paying fees. I'm paying acquisition fees, management fees. I'm paying a carry. Net, as an LP, I'm making more money. I should have just given all my money to these funds and gone on the beach and relaxed. Instead, I'm here dealing with the heartache of, construction projects that aren't going well, and my real estate projects were cash flowing, but even then, the return did not compare. That was very humbling for me. And that's when I contacted one of the funds, and Bluefield was one of these funds, and I'm like, hey guys, how are you doing so well? And COVID hit, and I'm like, oh my God, I've got a lot of Class C, and people aren't paying their rents anymore. And those special, funds that the government's supposed to disperse aren't being dispersed. And that's when I decided, you know what, I'm going to join Bluefield and do more things with Bluefield. And now I can see, wow, when you have the access to debt, the better access to equity capital, you've got other partners coming in, you've got construction people that you've worked with for in some cases, generations, right? Some of the partners at Bluefield have been doing this, their whole life. It's like, wow, I can see now. And they're so rigorous with underwriting, and pro formas are pro formas. You tear them up and you rebuild it from the ground up and you walk every single unit. And it was those lessons I felt that, I'm learning a lot here. And I think that's where I realized the transition into joining a platform makes more sense.
That's fascinating. Have you unwound your other holdings on the family office side, or how have you gotten yourself free from that, working yourself to the bone, owning your own real estate side?
I brought in better property managers. I felt like the managers you have on the ground are very important. I also felt that with anything, if you don't visit and fly out frequently enough, things get neglected and communication starts to break. So I haven't sold off anything. I bought everything with cash. I didn't use any debt. So I'm proud of that. And that means, I have the holding power, and I'm determined to fix these assets. And I also bought a lot of assets that are very much like Section 8 housing. And there's sort of like a nice feeling about that, that I'm in this tough asset class. I'm learning a lot, and I'm making a societal impact in some way. You don't have to evict people the way others might, and you can work with tenants. And I enjoy that aspect. But at the end of the day, every tax season comes and I'm flooded with IRS fines now because some of my returns are late, just overloaded with paperwork. And it's like, okay, I do probably want to get out of this eventually. But for now, I've got a plan in place, and I'm excited to see progress. I'm excited to see the cash flow increase and some appreciation come from, everything's hot right now, man. I mean, we bought everything pandemic and just prior to pandemic at the family office, and everything was going up in value. And I've had offers too, and those are more than what we paid for, some of these assets. But I want to see these assets improve. Some of these places were like really bad when I went to do the site visits.
Wow.
And now I'm seeing them improve, and it's exciting, to clean it up.
What gave you the confidence, to move forward with such troubled assets? I mean, I would think as a new investor, even for me as an experienced investor, I still walk from some of those things. And what gave you that confidence?
I think I grew up in a poor neighborhood, so I'm not fazed as much. But really, I'll tell you something actionable here. Such an amateur mistake. I got obsessed with the price per unit. And I didn't want to start doing big deals. I was doing small deals here in San Francisco. I had this sort of arbitrage, I figured, where you can buy these things called TICs, tenant in common units. Yep. And then, the resale value is lower and it's hard to get financing on. But I'd buy them with cash, and then I'd just cash flow them, and I'd get like a 5% cap rate or higher on condos and TICs. And that was doing really well pre-pandemic. And it's actually still doing really well too, even though everyone's apparently leaving. But I didn't want to go and start buying 50 unit, 100 unit buildings in California, man. That would have been sometimes hundreds of millions of dollars. And I didn't want to take that type of risk.
Sure.
So what do? I look at the price per unit here, and I'm like, oh my God, these are like several $100,000 a door, versus places like Texas where I started buying, and I was picking up things for $40K a door. That's what happened. I was like, okay, wow, I can have hundreds of units. I ended up buying 400 units across 5 buildings through the family office in Texas across different areas. And, you get obsessed with price per unit. And that's not the best way to look at it. And that was one mistake. And I would rather have, had I known better and had better business partners, and hadn't relied on those representations too much, I probably would have gone to Houston or Austin and spent the $200-300K a door, because like Austin rents are up 20%. I mean, hindsight. I can say that with hindsight about every asset, though.
Sure, sure. Man, that's really fascinating. With Bluefield, what's your role there other than a capital partner or maybe a limited partner? I mean, is that it, or is there more to it?
I'm on the investment committee. I'm a general partner, and I'm involved with everything. Sometimes flying out across the country to look at assets. Everyone has to find a role for themselves, and we've got a good mix of skill sets on the team. We set up a fund as well, sort of an opportunity fund where we can go out and buy. And I brought some tech people in too as LPs, where we can go and buy, assets that we think will do really well through COVID. So yeah, it's pretty much everything, doing site visits and analyzing the financials and interviewing property managers and, figuring out what to do there. I also set up, because I'm a tech guy, I have this itch, right? So I also set up a venture capital fund with Bluefield where we invest in technologies that can help our portfolio, things that can cut our operating expenses, technologies, or things that can improve our revenue, like amenities. So there's a lot of startups that are trying to help real estate owners maximize the value of their assets. And so I can't help but be attracted to that. So I also run the venture capital fund, and we've made investments in a variety of technologies that we're using to give ourselves an edge to improve our ROI.
That's fascinating. What sides or what parts of the real estate industry do you see the most glaring opportunity for tech to be disruptive?
Oh my God, every area, honestly. I mean, if we'll talk about multifamily last because that's my passion and that's Bluefield's focus. But things like hospitality assets where you've got, you don't need a check-in desk sometimes, and you can have contactless check-in and you can automate things through smart access control systems. That's an opportunity I'm seeing in that asset class, for example. I'm seeing new uses of real estate, repurposing retail, big box retail into industrial warehouses, co-living spaces and co-working spaces. But in multifamily, I see opportunity everywhere, every part of the value chain. I mean, how do you find deals, right? That's where it starts. In this business, I really think it comes down to three things: finding deals, getting access to capital and funding your projects, and managing those assets effectively. So I think about technologies that can help there, and finding deals as all types of AI technology that you can use to underwrite and analyze projects. When it comes to raising equity capital, as investment management platforms, so that you're not just using a spreadsheet like so many funds out there, you're using something more sophisticated, and running the asset is my favorite part. We've made a ton of investments. There's one company we invested in where tenants get a cashback if they pay their rents on time. And, we might incentivize tenants to say, look, if you replace the AC filter, rather than us spending a couple $100 sending a maintenance tech out, do it yourself and we'll give you $50 in your app. And 84% of these customers for this company, stake.rent, which we invested in, 84% of them have more money in their app now than they do in their own savings account. Wow. See, this is the problem with technology, and this is the solution. Technology, the problem is a lot of Silicon Valley tech people, and I might fit into that stereotype now, live in luxury apartments and build technology for Silicon Valley. And they don't realize that mass America, your average renter has a net worth of $6,000, I think it's $300, okay? Mass America lives in Class C housing, workforce housing.
Right.
That's where the technology can really make an impact. But of course, I think a lot of VCs don't appreciate the value of like a $500 saving for a renter, whereas $500 is huge. There's one company we're looking at, joinroost.com, where they allow tenants to tap into their own security deposits when they need it. Because what's a tenant supposed to do? Like go take a payday loan and spend like a 200-300% APR? Why can't you just why can't you just take some of your security deposit back out and pay a tiny, fraction of the APRs that exist? So there's technologies like that I think can really help improve your rents and create a better resident experience, which is where my passion is.
Yeah, that's really tremendous, and it will be interesting just to see where this goes in the future, and the it's interesting also that you say there's a disconnect between the tech world in Silicon Valley and then the rest of the country, where it's like, wait, why does this even matter? Well, it matters quite a bit. So that it will be just, I think, tremendously fascinating to see where this goes in the future and how that technology changes things. You mentioned something, and we've had a previous guest on the show that spoke about this as well. Automated underwriting, automated going out and finding deals, and I mean that can cut a tremendous amount of time off the front end of even filtering through deals. How are you guys implementing that, and what difference has that made?
This is a world of opportunity. And on one side, deals die because you're too slow. Deals also die because, or not just die, you die. Frankly, you die if you buy a bad deal and you make stupid assumptions. How many deals I'm seeing where, Bluefield, right? We're very conservative in what we bid on. And we put a lot of energy and emphasis on really having good underwriting technologies. And some of that sometimes isn't even about the technology and getting comps. It's about going into the most basic assumptions. And I've lost deals. We're probably losing 9 out of 10 deals today because we're not bidding high enough. And
sure,
you think to yourself, what is the secret sauce? How are these people bidding 10, 20% over our bid, right? How is that possible? It's a bubble, man. Honestly, it really is. What I'm seeing out here, you ask these people, and I've asked them, like, how did you guys underwrite this? You know what I'm hearing? Well, we had to sort of modify the model. We're just assuming interest rates are going to stay the way they are forever. We're going to assume that cap rates are going to continue to compress. We're going to assume that rent inflation is going to continue to go the way it has. And also, some of these guys are large institutional players. They can get away with providing a single digit IRR to their investors. We underwrite for a 15% net IRR to investors.
Right.
You just can't compete with these funds who nonsense underwriting, really, I feel. Overpaying and putting earnest money deposits that are high, non-refundable. It's the greater fool theory. I'm not one to try to call the market, but this doesn't feel healthy to me today. We're trying to stay disciplined. All the underwriting tech in the world is useless if the GPs are getting FOMO, if you're getting pressure from your capital source to deploy capital. LPs are like, look, we've committed $10 million with you, or more or less, whatever. We want to put it to work, and you haven't invested that. And so the pressure is to go do more deals. And also the incentives for most GPs are to charge a 1 or 2% acquisition fee on the asset. And, the more deals they do, the more track record they can build. And I don't want to play that game. And our partners at Bluefield don't want to play that game. We've delivered a net IRR of about 33% realized to our investors, even, before I joined, right? For 7 years in a row, investors have multiplied their money with us. We don't want to give in to this situation. It doesn't feel healthy to me.
Right. That's really interesting, that you say that. I didn't plan on going there, what your view is on the market. So other than staying disciplined, buying only the deals that make sense, is there any other strategic initiatives that you guys are employing that are preparing you for a market correction? Yeah,
we're all guessing. Anyone in the investment management game who is, doing what they do is also guessing where the market's going. We've taken an approach to go after assets that are at the right size. They're not too big, they're not too small. A little bit too big for mom and pop guys, and most of those people want to sell. A little bit too small for private equity. We're talking assets that cost between $5 million to $50 million. Right? That's our sweet spot. That's where we try to deploy capital. 5 million is too small unless we're buying all cash. 50 million is about the right size. We'll only put in $10 million of an equity check. We're also going after secondary and tertiary markets where there's fundamental solid population growth. There is good diversification of the job or the employment situation. You don't have too much concentration in one type of employer base. Fundamentals need to be good, That's what we're doing. And then we're also looking at other asset classes. And we're having to do, the cost of construction actually is going down relative to the purchase cost of new buildings. So we're doing some ground up construction. And that's tough for us because we have some funds. We want cash flow. And I can't do those deals in those funds because cash flow is not going to be there if it's construction. Right. So we're having to do these side deals with different LPs where we're building townhomes, for example. That's a niche I love. Because of COVID, people want more space.
Right.
And this sort of 1,800 square feet or, 1,000 square feet to 1,800 square feet townhome with a garage or garage, as you Americans say, that with some land, I think that's really appealing. And some of the things we've done are 100% occupied. And they produce cash in year 2, year 3. You just have to get through the first year cash crunch situation, you know? So we're doing things like that we typically wouldn't have done in the past.
Right. No, that makes sense. That makes sense. Zain, this has been a blast. I've certainly enjoyed it. Thank you for taking the time to cut you out of your day to come on the show and just kind of give us an inside view of what it looks like to come out of Silicon Valley, start a family or office, get involved in real estate, some of the things you've loved, some of the things you haven't loved so much, and really the pitfalls that a lot of us need to avoid. Speaking of, one of my last questions is always this: if there's one mistake you can help the listeners avoid in real estate, what would it be and how would you avoid it?
I would say start small and try to find a partner, especially if you're new. If you find a partner that complements your weak areas, it gives you a lot of leverage, and you can do 1 + 1 is always more than 2 usually. Don't get obsessed with economics initially. Get track record under your belt. The more and more deals you do, the more track record you have, the more easy it is to raise capital. I'm telling you that as an LP, by the way. I invest a lot. Probably less so now than I did previously, but I've invested in, I don't know, probably 20 different real estate people or funds. Track record is important. I don't want to be it's not like a startup. I don't want to be the first check and paying for you to figure it out.
You've done enough of that already.
Yeah, exactly.
Your appetite for that is over. Completely understand. I love that. Next question for you is this: when it comes to investing in the world, what's one thing you're doing right now to make the world a better place?
Outside of the affordable housing situation, investing in those types of technologies, I have a foundation. A lot of what we do is anonymous, but we're going to be releasing some things publicly at some point. I'm sponsoring, and I'm the executive producer as well in a few climate change documentaries. And these climate change documentaries are focused globally in areas like India, looking at the actual impact of the, people on the ground, the villagers, the fishermen, fisherwomen. That's becoming a bit of a passion for me.
Interesting. That'll be fascinating. We'll have to stay tuned and see what that is when it all comes out. Zain, I've certainly enjoyed this. If our listeners want to get in touch with you or with Bluefield Capital, what is the best way to do that?
Yeah, you can follow me on Twitter, Zain Jaffer, ZAINJAFFER. So I'm on Twitter quite a bit. My family office portfolio is Zain-Ventures or Zain -, whatever you guys call it, ZainVentures.com. And if you want to get in touch with the startup I mentioned, Stake.rent. Really interested in that. I think it works well for affordable housing. And the other one I mentioned was Roost, Join Roost, where people can tap into their security deposits. Both of these we're using in our portfolios, and it's part of our secret sauce on that asset class.
Man, that's fantastic. Zain, thank you so much for your time today. I do appreciate it.
All right, thank you so much.
Hey, thanks for listening to the How to Scale Commercial Real Estate podcast. If you can do me a favor and subscribe and leave us a review on Apple Podcasts, Spotify, Google Podcasts, whatever platform it is you use to listen, if you can do that for us, that would be a fantastic help to the show. It helps us both attract new listeners as well as rank higher on those directories. So appreciate you listening. Thanks so much, and hope to catch you on the next episode.